Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we have someone interesting in to talk about something interesting. And today it's Professor Steve Keen from the University of Western Sydney. G'day Steve, how's it going?
Very good, mate. Very good to be here.
Now, you've been writing on your debt deflation blog about the global financial crisis for years now. And you have a slightly different view about how the global economy and financial system works to the one we're used to, what we could call the neoclassical view from the likes of the Reserve Bank and the Treasury and the bank economists, who seem to say that debt doesn't really matter, that what's driving asset prices and the economy is the usual fundamentals. But you have a slightly different view about, well, quite different view about how asset prices have moved over recent years and why debt is important. Could you explain to us why you think debt matters so much?
The funny thing is I can explain it very easily to somebody who hasn't done an economics degree, and it's almost impossible to explain it to somebody who has. Because the basic story is, if I say to you, you're an individual, if you go shopping, you can go shopping two ways. You can reach into your pocket and pull out cash, or you can reach into your wallet and pull out your credit card. So your spending is going to be the sum of what you earn plus your change in debt. Now that aggregates to the national level, so the total spending in the economy is the sum of income plus the change in debt. Now an economist hears that and says, double counting, because what's really happening is that when I increase my debt, it means that I've borrowed money from somebody, and the person I borrowed the money from therefore has less money to spend, so my increase in money in spending by borrowing is offset by somebody's lending to me who can spend less, and therefore you can ignore debt at the aggregate level. That's the logic they follow. Now that'd be true if you and I were, buying and selling by trading clamshells. There's only a fixed number of clamshells we've got, and you give me some of your clams, you've got less clams to spend, and therefore aggregate spending isn't affected. But banks don't produce clams. Banks use double entry bookkeeping, and they simply, the way it works is, I've got a certain amount of money I've saved, and my money's in the bank. You go to the bank and ask for a loan, and rather than saying, here's some of Steve's deposit, you can have it, spend it, burn it, and I go to the bank and find, hang on, I can't spend as much, which of course obviously doesn't happen. What in fact happens, the bank says, great idea, Bernard, here's $1 million, by the way, you owe us $1 million, double entry bookkeeping, and the additional money they create adds to your spending power without subtracting from mine.
And what does this mean, though, for
what it means
asset
is
prices in the economy?
That then means that the total level of demand in the economy, is being the sum of income plus the change in debt, is then spent on both goods and services and assets. So you buy newly produced goods and services and pre-existing assets with that money. And that therefore means that the level of asset prices depends upon the change in debt. So to sustain where asset prices are right now, you've got to have the rate of change of debt being relatively constant with the rate of growth of assets. If you have in fact the rate of growth of debt being faster than the rate of growth of assets, you're going to get asset prices rising. And the fact that it actually causes asset prices to rise, if stable prices rely upon a constant rate of change of debt, then rising prices require accelerating debt.
So it's got nothing to do with income growth or migration?
It's got a bit to do with income growth and a bit to do with migration, but the major factor by far is the acceleration of debt. That's the driver behind demand.
So what happens when that debt acceleration slows down? In fact, you have
asset prices go down. All you're tracking with the change in asset prices after you get an asset which finally gets some sort of if you imagine a house being built and then it's improved and you get rental income coming out of it and so on, then there's a relationship between the rental income and the value of the property. But once you start getting speculation on top of that and people are playing flip that house, then what drives the house price up relative to the income that it can generate is accelerating levels of debt. So if I sell it to you and you borrow, with a loan to valuation ratio of 70%, and you sell it to somebody else who borrows to 75 and 80 and 85 and 90, that's what actually drives the house prices up.
So we've seen in Australia and New Zealand house prices rise quite sharply in the last decade or so, and they haven't come off to the same extent we've seen in the United States and in Europe. Why is that?
Because we haven't decelerated as much as they have. If you take a look at the level of mortgage debt, and I'll be talking about this in great detail in my talks over the next few days here in New Zealand, if you take a look at the level of mortgage debt and the change in that mortgage debt over time, the Americans hit up to about mortgage debt being about 86% of GDP, and they're now down below about the 75% level. So they went from rising and accelerating mortgage debt to quite plunging mortgage debt, then bounced up and down a bit, but that huge acceleration and deceleration was really, really marked in the American case. Australians and New Zealanders had a faster rate of acceleration than America and had a higher price appreciation than America as well, but haven't yet decelerated. And part of the reason probably is that in America, when you've got a mortgage, you're stuck with a fixed interest rate. And therefore, no matter what the Reserve Bank does, unless you get rid of the mortgage, you're paying that huge burden. Where the variable rates mean here that we get sucked into exactly the same dynamic, exactly the same problem, but then when we get into a problem, the Reserve Banks can take the pressure off by dropping the interest rate. And that therefore means you don't have the same pressure to de-lever. But what it does mean, of course, you're carrying a debt burden, which is going to constrict your spending for the indefinite future.
So what does that mean then for the Australian and New Zealand housing markets and economy?
Well, the housing markets can't go much higher than they are now. The New Zealand, looking at the New Zealand data, your mortgage debt is accelerating again right now. So I do expect for the next 6 months or so to a year to see rising house prices in New Zealand. But your level of mortgage debt is now higher than Australia's and higher than America's. The only country that I see that Anglo-Saxon country with a higher level of mortgage debt to GDP is England. Now, they're doing great guns, of course. You want to emulate the English economy? You know, they got to far more massive levels of debt than we've got. England's private debt to GDP ratio reached 450%. New Zealand's is about 180. Australia's reached a peak of about 160. But that is still, in the case of Australian case, that's 6 to 7 times the debt we had back in the 1960s when the interest rates are the same as they are now. So you can't say it's because, you know, interest rates have dropped, we've taken on more debt. We literally have 6 times as much debt as back then. So you've reached a ceiling in debt, and households have never carried this much mortgage debt ever before in their history. So,
but isn't there the chance that the Reserve Bank of New Zealand and Australia continue to cut their official cash rate and drive down those interest rates even further, meaning people can afford to borrow even more?
Which is one of the dangers, because you continue pushing yourself into the corner where you simply cannot take in any more debt, because the maximum amount that the Reserve banks can drive mortgage rates down to is about 3%. But that's, you're hitting this, if they hit zero reserve rates, then the mortgage rate's going to be no lower than 3%. So you then can have an enormous burden where, like in Australia's case, we could get to the stage of carrying, say, 240% of GDP as a debt level, which at a 3% rate of interest, you know, is going to give us 7 to 8% of GDP going to service debt. Now that is, we can handle that, but that's always been the line at which we go from recession to boom. Anything above about 8% of servicing costs means we go for a slump. It's the point that's as far as we seem to be comfortable with handling. So you get to that point, what it means is you're going to have a future where you can no longer rely upon the change in debt to stimulate demand. Now, in fact, increasing debt stimulating demand is a good thing when that demand finances genuine investment. But if you don't have it financing investment but speculation instead, and then you reach the limit we've hit with that being, you know, largely speculative debt, then firms stop borrowing to invest more than their retained earnings, and the rate of growth of the economy slows down, and you go to an indefinite slump, like the one Japan has been in for over 2 decades now.
Is there much headroom left, though, for us to increase debt if we see reductions in the official cash rates?
Not a lot. Like I know in the Australian case, they're carrying about, in fact, in total debt levels, about 7 times what they were back in the 1960s. There isn't much headroom left, and people are suffering mortgage stress throughout the entire society. It's permeated from low income to high income levels. So I can't see us carrying much more debt.
So how do we get out of this problem? We're seeing it hit the rails in the United States and in Europe, where they simply can't take on more debt, and you've seen financial crises there. How does the world deal with all this debt?
We have to realise that we were conned into it in the first place. It was the banking sector profits by creating debts. They've always got a motivation to create as much debt as they can manage. And there's, as I said, there's a certain level of debt which is productive in that it finances investment, it finances some consumption that you can't finance out of your wages, housing being an obvious example, cars and so on. So it's useful at that level. But when you get to the stage where it's borrowed mainly to finance gambling on asset prices, and the actual act of borrowing the money is what's driving the prices up to begin with, then you're caught in a very deadly cycle which has to break down. Now, when you get to the point of that level, you look at it, well, we should never have allowed this level of lending in the first place. It was irresponsible lending. We should eliminate it directly rather than forcing people to honour that debt and pay it down very slowly over time. Because if they do, again, we could turn Japanese without the benefit of being able to export to the rest of the world that Japan had to get out of the problem. So I would go for abolishing large parts of that debt. But of course, abolishing it.
How would you do that?
Well, the old-fashioned way was a jubilee. And that was quite simple in the ancient societies because there was a defined money lender who had all the assets. He had, his assets were the rest of society's debts, and they could be declared that either on the 50th year of the reign of a particular king or the change of a reign, all debts were abolished, and that became instituted into ancient societies because they realised you had this tendency for an exponential rate of growth of debt, but what you might call a logistic curve rate of growth of productivity of land. And therefore, you'd always get this point where you had to reset, and they built it into their societies. Now, we think we're too clever for that. We don't have to have that same exponential level of debt growth, but we've allowed it to happen. And consequently, we are now in the same situation those societies were, with the double whammy that the banks have also securitized this debt and sold it to people as assets. So if you wrote the debt off, rather than just affecting the moneylender as you used to do, you'd also affect people who are quite legitimately buying for pension funds and councils and so on.
So you really have a conflict here between the banks and the pension funds who own the banks and own those securitized assets, and people who've borrowed the money. Who's going to make a decision about who takes the pain?
That's why I've called what I call a modern debt jubilee, where we have two ways of creating money. The banks can create it by borrowing money into existence, or the government can create it by running a deficit, or the Federal Reserve can create it by double entry bookkeeping, with being the control of the money supply. I'm saying the Federal Reserve should do that and do what I'm calling quantitative easing for the public. So rather than giving the money into the banks into their reserve accounts, which doesn't have any impact on lending anyway, to give it to the public through their bank accounts, but have the condition that if you're in debt, your debt must be paid down. But if you're not in debt, you get a cash injection. Now, what would then happen, there'd be a chain reaction of debt cancellations and paying down debts and reducing the value of bonds and so on, which would then disadvantage anybody who owned those bonds. However, those people who got them as individuals through their bank accounts would have a cash injection.
Doesn't that then just reward the profligate, the borrowers, and create a moral hazard?
No, it would do that if it only gave the money to the debtors. I'm saying give it to both. We have to admit that the banking sector made the mistake. Okay. And the banking sector sucked in savers and borrowers simultaneously. We both got conned by the banking sector, which was conning itself as well and got to be far too big. So what I'm proposing would actually compensate people who are savers by giving them a cash injection to compensate for the drop in the value of the asset they bought off the banks. Debtors would have less debt burden, but they shouldn't have been encouraged to borrow that money in the first place. They were conned by, banks with PhDs backing them up, and the rocket scientists talked them into saying this was a good idea. The only sector which would suffer would be the banking sector, because their assets would be changed from lots of loans and a small amount of cash to many less loans and lots of cash. They wouldn't have any crisis in terms of solvency, but their cash flow would be drastically reduced. And we have to reduce the size of the banking sector. So this idea would limit the damage in terms of reduced income to the banking sector alone.
Wouldn't it create inflation, though, if suddenly a bunch of people had a bunch of money in their accounts?
You're really changing the nature of the money backing the bank, because what we're doing is really swapping, effectively, credit-created money for government fiat-created money, and not necessarily increasing the amount of money in the economy. And you could also test this on a small scale. You wouldn't have to do it, to actually reduce the level of household debt in America back to where it should be, for example. You'd be talking an injection into household bank accounts of something of the order of 50 to 60% of GDP, say $6 to $7 trillion. But you could trial it in the $700 billion levels that were tried by the original Obama rescue and see what happened. Because this is not the sort of thing which has to be an all or nothing whammy. You could do it in increments and see What happened after it? Did we have a huge spike in inflation, or did inflation not really change? Have we actually seen an improvement in consumer spending? You could test it that way.
And though there's a lot of political pressure coming from the banks, for example, who would see their businesses completely transformed and different. What's to stop them saying, no, it's not going to
Nothing's to stop them saying no, so we have to say, well, no back. It's about time we got some balls behind our politicians, or rather, if we actually realise who's got the knife on the chopping block on which their balls reside. For a long time, they regard the banking sector as the one that actually controls them like that, and that's been the case. Particularly in America, there's been such a blending of the political sphere with the financial sector that they can't imagine a world where they don't go and have meetings on a regular basis with the bankers to talk about how the global economy runs. Now, Marx got it wrong a long time ago, when he wrote that wonderful phrase, the roving cavaliers of credit. He said these guys know nothing about production and should have nothing to do with it. Well, it's dead right. We need to get the industrial capitalists back in control again, put the financiers back in the bottle where they belong, make them a minor but necessary but minor part of the overall fabric of capitalism, and then it'll work much better. But that involves politicians realising that it's not the bankers who are going to knock them out of power in future. It may well be the public if they don't take the bankers on. That's what happened back in the 1930s.
Professor Steve Keen from the University of Western Sydney, thank you very much. Professor Keen is here in New Zealand over the next couple of days, holding seminars in Auckland, Wellington and Christchurch, and the details for those seminars will be in the article underneath this video. I'm Bernard Hickey for interest.co.nz.